Ladies and gentlemen, welcome back to the FinTech Decoded podcast. I'm Musheer Ahmed, founder and MD of FinStep Asia. Is my co-host Monica Jasuja and our special guest Dr. Michael. We will be talking about a very interesting overlay on tokenized money, in particular looking at CBDCs, stablecoins, tokenized deposits, etc., and how they are rewiring how we transact both at an institutional level and retail level. Over to you, Monica.
Thank you so much. Pleasure to be here and to have Michael on this particular podcast. It's been a pleasure to actually meet him in KL, and I'm so delighted that we finally have him here. His work has been stellar, and he gave a presentation which left a lot of us spellbound, specifically because not only his opinion but his expertise on the subject, specifically what tokenized money is, and therefore how should institutions be thinking about it, actually had not just thought-provoking questions, but also led to certain conclusions that all of us were led to during that presentation. So thank you, Michael, for joining us today. Let me give a small introduction before I let Michael introduce and tell us about the span of his work across many decades. But Michael is an internationally recognized leader in digital and financial services innovation. His work spans payments, open banking, open finance, digital identity, AI in financial services, electronic money, and CBDCs and stablecoins. He has advised banks, regulators, central banks, industry bodies, and global institutions across the world. He's also the co-editor of his new book, which is called Tokenization of Money from Fiat Currencies to Stablecoins, which sits right at the center of today's conversation. So, Michael, a warm welcome to you. Great to see you here online after KL. I hope you're doing well.
Thank you so much, Monica and Musheer. Very nice to see you and see you again. Yeah, thank you for this opportunity for having a chat about all the things that are fun and interesting in payments. That's what we do in our company. We don't do the sort of standard stuff, as I sort of like cards and ISO 20022, but we do all the sort of innovations. And you've mentioned a few of those. And we do those helping regulators around the world with policy decisions, how to manage the risks above all, and with a lot of banks and service providers on strategy on how to exploit the opportunities that these new innovations offer.
Thank you so much. Actually, let's dive right in. And the reason why we're having this podcast is because the book, like I mentioned to everyone, I think the presentation was really good and it got me intrigued because the book itself raises many questions. But for our viewers and those who are listening to us, when we talk about money, we talk about money from the perspective of it becoming necessary infrastructure, which is now becoming programmable. But let's actually break it down and take a step back and really understand what tokenization actually does for money. And what does it mean in terms of how does it differ from digital payments? One of the most common misconceptions or conceptions about money, specifically tokenized money, is that, why do we even need it as when we have digital payments, which has become pervasive all across the world?
Mm-hmm. Yeah, let me try and take us through that. I mean, when I started a few decades ago, as you rightly mentioned, payments was a really boring topic and was done by people in the basement of a bank and nobody was interested in it. And now, of course, it's become a highly strategic and important topic. There are amazing technologies happening there. It's even becoming a geopolitical tool between countries. So the topic of payments has reached completely new dimensions. And part of that is indeed the digitization of payments, which raises some sovereignty issues along the way, for example. That's a big topic in Europe at the moment, that one doesn't want to be so dependent on foreign providers and foreign cards and foreign infrastructures. And it's also reaching a new dimension in this tokenization. And since you asked what that is about, the key premise of tokenization is that you wrap an asset like a dollar or whatever, or a stock or a bit of real estate into a cryptogram, to put it technically. So you package it into an unforgeable, unduplicatable, unmodifiable token, and this you can just send across the internet. So I can send a dollar or a euro or a share of my flat in Dubai just to somebody on the other side of the world. And that happens instantly across as fast and as easily, ideally, as sending an email. And that, of course, is a hugely disruptive idea. That goes way beyond just digital payments where I can tap my phone onto a point of sale reader or something, or pay in e-commerce.
So, Michael, I have a follow-up question on this. Like, one thing that we keep hearing is tech is going is probably progressing by leaps and bounds. We already have digital money, which occupies a very central role in all our lives. Why do we actually need tokenized money? Is it technology looking for a problem that we were trying to solve for? Or is it something that really is fundamental to how money will look like? Maybe in 2030, 2050, why is it even needed?
Yeah, I mean, that was indeed the case, that the technology was looking for a problem when this whole blockchain hype started, sort of after the financial crisis. And that's when crypto emerged and various other bizarre things that probably should never have been let out of the lab. But fortunately, the topic now is only about business. So it is, for example, how to do cross-border border payments better. Instead of going through correspondent banking and sending it to my correspondent bank, who sends it to his, until it reaches you, it gets sent directly from my wallet to your wallet. So that completely disintermediates correspondent banking. It may even disintermediate banks, because if I just touch my phone against your phone and the value gets transferred, then that, of course, changes very important structures. And those are the important questions, right? So what is happening to legacy players, to banks, to SWIFT, to correspondent banking, to transaction banking, all the things we've got used to for the last decades? These are now being seriously challenged. And that's why this is such an exciting topic. And it's important not to look at it from a technology point of view. And that's a mistake many people make. They think this is all about blockchain, and they do technical trials and have proved that 3 transactions can be done. And that helps nobody. The question is which new business problems are being solved. And I mentioned cross-border, and there are many others we can go into in treasury and in B2B and eventually also in retail, which are hugely optimized through tokenization. And those are the strategic questions, and where the new business models are being created, where new intermediaries are appearing, new players. And that is what we're dealing with. And it's not about technology.
And do you think, I mean, when we consider this, broadly speaking, and you're right, there's a lot of conversations have been too narrowly focused on blockchain, and as an extension, thinking that it's crypto, and then, bringing in concerns and guardrails against that, despite it being the conversation around how the technology works. My other thinking of what we've been looking at is this, we spoke about, okay, there are a lot of these benefits that tokenized money brings in. But are we creating almost a 2-tier digital economy, digital layers? I'll qualify that in the sense, in the work we've done and what we've seen, both Monica and I, and on a bunch of other projects, many of the emerging markets are still coming to terms with large-scale digital fintech infrastructure. Right? They are implementing it or in the process of scaling it, while tokenization goes to a slightly different level. While one may say that you've had leapfrogging and things like mobile and telco, this is a very different conversation where the cost of that leapfrogging is much more significant than what can be very well achieved with that one layer of digital finance in terms of regular digital payments and maybe faster payments, etc. So I think this is going to be a major challenge where we will start seeing, especially tier 1, tier 2 banks in most of the big global centers, and maybe some of the G10 economies who are able to go fast ahead with a variety of different use cases. But the second layer and the emerging markets who are still just coming to large-scale deployment of digital finance will be left behind, and it could have an impact on their economy. Any thoughts?
Mm-hmm. Well, you've raised a number of really good and very important points. Let me try and go through them. I mean, the 3 that stand out to me is, one is, how does this compare to crypto? And then the sort of layer question, are we just adding another layer on top, or what is happening there? And the third one is sort of around the inclusion topic, if I understand you right. So let me just quickly say something about each of those. First of all, crypto. This is definitely not crypto. Crypto is the Wild West, where people started inventing money or something that looked vaguely like money. It completely isn't money, but it was virtual assets whose only value was the hype. Bitcoin is not backed by anything at all, except that you find somebody else who's willing to pay a bit more for it than you. It's a Ponzi scheme, some people say. It is not backed by anything. Whereas these modern tokens, like stablecoins, deposit tokens, are backed. They are backed by bank assets, by central bank assets, or by gold, or by a title deed, or by a security. They are regulated. Only licensed players can operate this. So this new tokenized world uses the advantages of the old of these new technologies. We can discuss how new they actually are, but it uses the advantages of modern methods while putting it on a safe, secure, and backed system. And that is fabulous, right? Because that is what you want. You want $1. You don't want some funny internet money, and you want things where there are proper dispute procedures, liabilities, etc. So that's just a few short sentences on the differentiation from crypto. The second point was a layer, and that's a thing that's in hot debate, as some sort of token optimists say this can replace all that we have had before. This is just so much better in all its dimensions. It's faster, it's cheaper, it uses less intermediaries, it's transparent, it's direct, etc., etc. And basically, we can get rid of all the old. I mean, in the UK, I think we have 8 different payment networks. There's Bax and Chaps and Link and Open Payment, Pay by Bank, and there's and there's Cards, Rails, and we can get rid of all of those because now we have a super efficient thing which works for anything, from micro payments to large B2B payments, from local payments to global. And that's quite a convincing story, right? It's like the story that we used to have on our bedside table, an alarm clock and a radio and we had a calculator somewhere, and now that's all been subsumed in the iPhone because it can do everything. It's a universal instrument, and that just wins against all the specific ones, right? So that is the one story which some people are saying. I'm not so optimistic on that, quite honestly, because I'm not sure that there isn't a value in actually optimizing some networks for micropayments, which may be different to the optimization for large wholesale B2B things. But it surely is a massive improvement in efficiency, and therefore it will challenge the existing infrastructures and rails, and eventually some of them will hopefully be able to be retired. The third point, you're really challenging my head here to keep all these dimensions in a line, is inclusion. And there is a lot of argument that being made that this tokenization is absolutely something that will help inclusion. Because you don't need to open a bank account necessarily. You just need to get a wallet. And we've seen in various parts of the world, in Asia and Latin America, that there are service providers who fully understand as agents or as kiosks to provide wallets to people who have less access to modern financial services, and they are therefore brought in with this tokenization world. And if you can send money, remittance money, for example, to your family in the Philippines from the UK, much cheaper, much quicker, that is a great deal, and is something that is surely to be welcomed. So I hope I've at least made an attempt of answering your 3 questions that you...
Yeah, and I think we can touch a little bit upon wealth inclusion with tokenization later on as we break it down, because that's one of the concepts we've been seeing Brian Armstrong speak about. And I think that'll be quite interesting to talk about that fractionalization of large assets, which help with wealth inclusion across the layers, and which is very different to the financial inclusion concept, which is getting access to finance versus building wealth. But yeah.
Hmm. Yeah, I mean, this fractional, just quickly jump, sorry, if I can just quickly jump in on this fractionalization. Yeah. This is an interesting topic because it happens in my area, which is payments. I mean, what one is saying, infinite decimal places. You know,
for agentic, right? Yeah.
We've, as a payment industry, we've not cracked that. We've not cracked micropayments over the last decades. And if we actually manage to be able to send a cent or a tenth of a cent or 1 microcent, we open up whole new business models, on-demand things, every in Industry 4.0 and in IoT and in agentic commerce, when these agents will want to pay each other, we're going to need micropayments. And this is the fractionalization in that area. Which I think is super exciting because now it's actually economic to send even fractions of a dollar. And the other fractionalization, which I think you alluded to a little bit, this is above my pay grade. This is beyond payments. This is in real estate, for example, where you can now buy a fraction of a flat somewhere and not just buy the whole thing. And so whole new models are emerging there too.
Okay.
I want to take a little bit of a step back, Michael and Musheer. Actually, I was thinking more around financial inclusion, but I'll come to it in a second. But around the hype use cases, because and I'm one of the payment purists, have to say that, and there is a certain bias that I have in my mind as well. But when it comes to the value of money, we need the value of money to be legal tender, in my view. And that's when most of my hesitation comes in terms of crypto. But in particular, but I'm going to go back on tokenized money because now the hype has actually progressed much beyond what we have seen into actual legal mandates now that exist. But Michael, if I can go back to the book that you've written and also the presentation.
Sorry, can I just reply to you on that one? Because if we always stack the questions, I'm going to have an overflow pretty soon. But no, you raised the excellent point that you need backing, right? And that indeed was not the case in crypto. It was just sort of based on whether Elon Musk posted enough about Dogecoin on X, and then people started buying that. It had no intrinsic value. And whereas this is different. Every stablecoin is one-to-one backed by a dollar or by a euro or whatever currency. And deposit tokens are backed by the bank assets. So this is absolutely fully backed. It is just a new representation of money, a new form factor of money. But it has this property of the immediate finality of settlement, as we payment geeks call it. Instead of sending 2 messages as we do now, one is the money is coming and the other one is the settlement process, which may happen a day or 2 later, especially across border. This happens atomically in 1 message. So it's like me giving you a banknote. It's a bearer instrument. I give you the banknote, and when it moves from me to you, you now have that asset and I don't. Except now we have a digital bearer instrument. So I can move the money from me to you instantly, just like a banknote, but in the digital world. And I think that is an extraordinarily powerful paradigm.
It really is. And that's why I wanted to focus on the use cases, because we hear the hype. We've gone beyond the hype now. My question is, you specifically mentioned some of the networks having to retire, maybe are going to get disrupted and retire. But the real question is, which of the use cases, especially in cross-border payments or others, are you noticing will really benefit from this technology now becoming more mainstream, number one? And number two, when we think about the settlement side, because again, we are really talking on in terms of depth and specifics here. As payment geeks, we know that settlement is the hardest possibly in the chain as far as payments is concerned. Now, assuming that there is the trust which is instilled because of either the central banks or large enough corporations which are backing tokenized money, how are we solving for settlement in particular with tokenized money?
The use cases, I mean, we already see the use cases emerging now, especially in the B2B and the institutional area. Already billions and trillions are being handled in a tokenized form now there. The volumes of stablecoins have overtaken the sum of Visa and MasterCard now. They process more than those two together. Recently it was announced that they do more than the ACH in the US. So these are gigantic volumes, right? We're not talking about sort of pilots and just these stupid blockchain trials. This is real serious business that is already happening now, and that's just the beginning of the journey. Right? And the use cases now are indeed institutional and B2B. Cross-border is increasingly of interest, as we've discussed, right, as an alternative to the correspondent banking model. And eventually we will get to retail, right? This will vary by region. Like in Europe, nobody's particularly interested in that because we already have very efficient, instant, almost free, totally connected payments. So we don't need tokenized. But if you look at the US, where the payments infrastructure is not nearly as connected and as efficient and as instant and as cheap, I won't even mention the card fees that they have there, which is sort of 10 times what we have in Europe, and Latin America and Asia, where there are lots of islands which are not connected, and sometimes it takes a long time. So there's a huge potential in that. And retail itself may be an exciting story. If you remember, Mark Zuckerberg once launched Libra Diem. He didn't do it in a very smart way, so it collapsed pretty soon afterwards. But now that this is now he has a regulated basis, he is now having a second attempt. He's hired some experts in that field, and he's partnering with some people who are providers in this space. And it's not beyond the wit of man to imagine that all the Facebook apps will be connected and offer a means of sending each other money. So I can just send anybody who is on Facebook, and that's basically everybody, money directly through Facebook. And that, of course, is quite a scary concept, which we don't want the monetary system being run by Mark Zuckerberg. I'm just singling him out. It's just we don't want big techs to be to run the global monetary system. Right?
The source for a lot of the CBDCs becoming more active, or central banks becoming more active, CBDC was Libra, right? Which was essentially what you're talking about. It's scared, worried, call it what you will. Everybody about a 2 billion non-government managed ecosystem with a multitude of issues. Yeah.
Absolutely right, Musheer. That's in my view exactly what happened when Facebook came out and said we're going to do this. All the central banks got the screaming heebie-jeebies and said, "Oh my God, we're losing control of the money, and we can't have that." And that's why they all went into CBDC. Yeah. And had a look whether that's an alternative. And I thought I still think that was actually the wrong reaction. They should have said, okay, we need to reinforce the local system, the fiat system, like SEPA in Europe and TIPS and UPI in India and PIX in Brazil. Let's strengthen that so there's no need for a Facebook money and Facebook rails. But instead, they came up with CBDC and said, let's make our own rails, our own money, and our own autobahns. We're in competition to the private sector, and I think that's completely wrong. Fortunately, the central banks around the world have begun to see reason. It used to be 134 central banks around the world thinking about CBDC and doing their pilots. And there was a time when 11 had launched, and now they're back down to 3. And that's the Bahamas and a few of the old ones who initially tried it. So fortunately, the CBDC enthusiasm has waned considerably. The only one that is still forging ahead is the ECB in Europe. There's no stopping them. And they are investing billions into this, hiring hundreds of people. And well, we can.
Feels like India also is, right? If you see what SEBI is trying, so RBI is trying to push us, you've seen a significant increase in activity in more than POCs, proper use cases that RBI is exploring with the CBDC. And so I think that in China, it's cooled down to a large extent. However, you now had the announcement this week, about the commercialization of Enbridge in terms of setting up the entity here in Hong Kong for most on the wholesale side of CBDCs, but that will be interesting to keep an eye on.
Yeah, China is an interesting case because this is a state-driven economy essentially, so they can actually enforce a mechanism like CBDC, and they have done so. And I think 70 million wallets or something. I mean, that sounds pretty impressive. But if you think they have 1.x billion people, it doesn't sound so great, and it's not being used, essentially. And the People's Bank of China and the Chinese government are well aware of this. And they keep pushing it. For example, now they've added interest, so you can actually get interest on your EU1 to make it more attractive for consumers. But I think it's all not going to help people not interested in CBDC.
Yeah, I was just going to say, I don't know if you all can see it, but that's my eCNY wallet on BOTI.
There you are.
And I'm a Hong Kong resident, so I have access to it. So yeah, it's straightforward. It doesn't really, no one here I mean, you get a sense of blockchain or, your private keys, etc. It's a wallet and it has some certain currency, and that's where it builds up and probably brings to our next question.
But sorry, but which consumer wants wallet and blockchain and private keys? They don't want any of that, right? They want a convenient way of paying, which is secure and where they can get their money back if something goes wrong, right? And it's so confusing. I mean, I've seen sort of prototypes of the digital euro where you sort of see in your mobile banking wallet from your bank, you have a sort of savings account and you have a gyro account and you have your card. And then you also have a central bank euro as well. Who apart from people like you and me understands that? Nobody, right? And then you have an offline one and an online one. And the banks hate it because, of course, it's going to draw liquidity away from them. The merchants, it's a huge investment in their terminals. I'm really struggling to see which problem is being solved, which makes it worth all this pain.
I think Go on, Monica.
I think there is so much written about CBDCs in particular, specifically in countries where digital payments has taken off, that there is really no more room left to introduce another type, which confuses users, because we need to grow. There is enough headroom, and we need to think about financial inclusion, which is provide access to everyone. We are still hitting literally the ceiling when it comes to people who are educated, who are digitally savvy. We are solving for fraud issues. But I have one small follow-up question for Michael before I move back to you, Musheer, on CBDCs in particular. You've mentioned CBDCs and governments and trust. Since the pilots, there is interest that is waning off. In terms of the central use case for CBDCs, would you agree that it is programmable money for subsidies and other such benefit schemes that the reserve banks want to control, the central banks want to have access to, and thereby that it makes sense for these countries? Or is there any other such programmable money use case that we are not thinking about, which mandates and requires such a big investment in both time, money, and resources of the payments industry to fit another type in?
Yeah, programmability is a complex topic. Everybody who talks about programmability means something different. We see that just to stay with our topic of the digital euro, they've been very clear that they want programmable payments, which is good, so that they're going to be an API on the digital euro so that fintechs can initiate a digital euro payments. That's great. But they don't want programmable money. So they want programmable payments, but not programmable money. So you've already got to be a bit of a geek to even understand that difference. Programmable money means it can only be spent in particular circumstances, like you can't spend it on alcohol or on gambling or something. But they say, no, the digital euro needs to be fungible and needs to be everywhere. So we're not having programmable money. That's one sort of example of where you get into hot water when you don't use the term clearly. Another one is a lot of this sort of blockchain friends talk about the programmability of money. And sure, there are these smart contracts, which, by the way, are neither smart nor contracts. They're just if statements, and they have no legal value. So there is quite some contention whether smart contracts are indeed the right term for that. But either way, you can put some conditionality into the money. But the question is, do you really want that in there? Is that the right level? because you're going to want all sorts of other conditions and if statements and refund procedures and things at higher level. And is it actually a smart thing to put it in there? And there's a strong debate about that, which we don't have the time to explore here. I'm just saying programmability is a complex topic, and it depends on what you mean by it. And some of the advantages being cited are maybe not that real, because we've had programmable money forever. When I get out of an Uber, the driver gets paid, right? That's conditional money. We've had that for, I don't know how long Uber's been around, right? We don't need blockchain and smart contracts for that, right? Sorry, that was a bit of a rant. I will try and hold back in future.
I think that's fundamentally what Alipay began with, right? Because it was an escrow account for enabling payments to Alibaba. And that essentially is programmable, right? Which is, have you received the delivery? Yes. Okay, now we'll pay the merchant. Till then, right? It stays with in Alipay or Ali, at that stage. And I just wanted to build on a couple of things and building on that CBDC conversation further. I guess there's this conversation to be had whether CBDCs have now reached a stage where they are POCs looking for real world use cases, because so much time, effort has gone in, right? In a lot of jurisdiction, it was like, okay, we can get control. Here are these stable coins are coming, or here are these, Bitcoin was going to take over the world, which it hasn't. Stable coins to a certain extent, but once the regulated element comes in, we'll talk more on stable coins later. But I do almost feel that we've reached a stage where we are, going the other way around, which we always talk about innovation. Sometimes, as Monica mentioned at the start, a solution looking for a problem is, I feel CBDCs are maybe there, and some of the use cases to a certain extent that are workable. One is this wholesale CBDC conversations where you don't have to anymore have a dollar intermediary for exchanging, because you're then relying on the central banks to provide that value exchange between them, right? So the Enbridge project, essentially, if I'm going to dumb it down that way. The second one I kind of think is very workable and not being looked at as much, and I do think India should definitely look, because they're being quite active on this side, is the use of CBDCs for the tokenized securities and the tokenized finance area, where a majority, and this is overblown, I feel cross-border is overblown quite a bit in the sense of the importance. It is very important, but the utility, right, a vast majority of financial institutions function locally. And that's why you do have these global intermediary banks who provide that rails overseas. But if you're thinking locally, if you want to settle, it's an Indian securities firm, it's an Indian retail or institutional client, it's the Bombay Stock Exchange or the National Stock Exchange. And then if you need the settlement layer there, then yes, if it's tokenized securities, you could then use the rupee to be the settlement layer. Thoughts?
Yeah, no, I totally agree with you there. That's a use case we haven't even talked about now, is that when you start digitizing or tokenizing the value chain of securities, you're going to need this DVP, as it's called, right? Delivery versus payment. And so as all the NASDAQ and everybody is tokenizing securities now, you obviously need the payment leg of that also in tokenized form. And in fact, you may want it in central bank money. And that's where CBDCs play a big role. I'm totally with you there. The rant I gave earlier was more about the retail CBDC, where I think the state has a role in providing a competitive infrastructure to the publics, to the private sector. If
you will indulge me more, and if Monica allows me, there's another thing I felt, but maybe because we are on the CBDC and programmable money conversation, the other thing that I kind of think about and question often is, now with agentic payments, and let's be frank, with the ability as such, it's just a matter of a couple of months where you build a governance, strong, robust layer around it. Agentic finance or agents are essentially programmable, right? Or action oriented. So if you have a faster payment system and then you attach an agentic element to it, then do you really need a programmable central bank money anymore? You just need to ensure your agents are well governed, and then that goes out of the window. Now, that could be the agent then feeds back into a blockchain, which then becomes a data collection conversation rather than the action item, right? So all the data is collected on chain, but the transactions are off chain from that perspective.
No, absolutely. I mean, this is the point I was trying to make earlier, right? We're going to have all sorts of conditionalities and programmabilities and at all the levels, and agentic is just yet another layer on top of that. There's no argument that this has to be inside the money itself. But the connection especially between stablecoins and agentic is super interesting, because agents don't want to pay each other by doing a SEPA credit transfer, right? And you're going to want some digital form of payment where they can pay, because they're going to be 100 agents doing your flight booking, organizing your holiday. They're all going to talk with a network of agents at the airlines, at the hotels. So there's going to be whole network of agents talking to the other, and sub-agents, which they're going to create to do subtasks. And these all need to be paid. So there's going to have to be some money where I pay my travel agent in the modern sense $1 to find me the best deal to fly to KL next time. And it then has to distribute some of that to some of the sub-agents to find the best flights and the best hotel and the best rental car and etc. And that, of course, needs to be done in a super efficient, instant, cheap way. And that's where stablecoins are a fantastic solution for agentic commerce.
Actually, can I go a little bit further on stablecoins? It's becoming necessary financial infrastructure, and I love the fact that we are discussing about agentic commerce, where I think there are a lot of discussions still in progress about agents and specifically the governance piece. But in terms of the settlement layer, tokenized money plus agents is going to be the shape of agentic commerce, which I think mostly agree on. But coming back to stablecoins, apart from all the regulations piece that we will not probably have time to run into, when we talk about the financial infrastructure, is it fair to say that the conversations had been there and the technology definitely existed, but it becoming mainstream now is an indication of something bigger in the future? Or how does the future actually look like with stablecoins becoming central to what we are discussing today in 2026?
It's actually quite an interesting evolution if one sort of steps back and looks at a bit of a historical perspective. I mean, after the financial crisis, some people said, I don't think the banks and the governments are doing a great job. We need another form of money. And that's where the Satoshi Nakamoto paper came and really hit the sweet spot. It said, yep, we can do a different kind of money where decentralized, no governments, no banks involved. And that led to the crypto with all the disasters that happened with that, right? Exchanges collapsing and volatility and fraud and ransomware and all that. And then people sort of said, I mean, I like the idea of a sort of more decentralized way of doing things, more efficient, more direct, more immediate. But can't we put that on a more sort of legal basis, funded with proper money, not some internet hype, but sort of real dollars and everything? And then CBDCs and stablecoins sort of emerged, one more from the state side and one more from the private sector. Now, CBDCs, as we discussed, the interest is waning a little bit, but stablecoins is still an extraordinary path. But many people are now going towards deposit tokens and saying this is actually a better form of tokenized money. Especially the banks love this, because for stablecoins, they have to put each dollar that they emit a stablecoin with into a reserve which they can't touch. So they can't work with the money. Whereas with deposit tokens, when I issue a deposit token, that's legally a different instrument, they can continue to work with the money. So it doesn't reduce their lending and their book and everything. So that's why there's quite a big interest now of deposit tokens happening. And who knows what the next thing will be? We're already beginning to see digital repos, tokenized repos, and money market funds and everything. It is super exciting and a scene that is super in transit. And that's, of course, why we said we would write this book, because there's so many fascinating dimensions: legally, commercially, security, identity. What are the policy questions? What does this mean for consumers, for businesses? And that's where we felt this is a good time to write the book.
Yeah, that's the irony, right? That a regulated stablecoin is probably safer than a bank from a solvency perspective, just because they have all the money, whereas an insolvent bank has money out there, which works for the economic system, and that's a whole different conversation. But back to you.
Well, the CBDC is the one with the least risk, right? It's backed by central bank money, so that's the most stable. And we're given nice regulations like MiCA. I mean, Europe again was the first to regulate, and I think everybody's basically copying that blueprint again, like in GDPR and various other things. Europe is always ahead in regulation. Not always in the implementation and creating the big giants, but the regulation that people are very good at in Europe. And so if, as this regulation gathers hold around the world, we're get all these stable forms of tokenized money, like stablecoins, like deposit tokens and others. And that's surely good news.
So I actually want to double click a little bit on this because we've mentioned banks a couple of times, but we actually have not talked about what the impact on banks is likely to be. Or are banks actually going to get disrupted as well or disintermediated? Because with all the payments conversations all through decades, everybody just talks about the disintermediation and that tectonic shift that's going to happen. But in the case of banks, they are actually asking, and a lot of the bankers ask the question, are we getting disrupted? Are we upgrading? Or is it just one of those fears, which is a technology fear, which suddenly has, taken over boardroom conversations? What is really the impact of tokenized money on banks? And we've talked about a few use cases, but essentially, how are banks, when you're speaking to them, looking at this and perceiving this threat?
Yeah, that's a completely fascinating topic. In fact, next week I'm at the Oxford Business School Bank Governance Program, where I'm talking about tokenization on exactly that. What are the consequences for banks? I mean, I've been working in the banking sector for a long time, so I'm quite a fan of the banks and I like to be on their side. And the good news is the banks are very much needed in this space, and the smart banks are already entering into this space. I mean, we've already talked about this custodial topic, that there's somebody will need to look after the money. You don't want that in some fintech garage with two guys and a dog who will hold the reserves for these tokens. That needs to be at a bank and other licensed institutions. But even in the service providers, to make this whole ecosystem work, it's been completely fascinating. The MiCA regulation in Europe allows not only these token issuers, but also CASPs, as they're called, crypto asset service providers. So so that's exchanges and etc. in this space. And over 200 licenses have already been issued, and quite a lot of them are banks, and a lot of them are German banks. So that's quite surprising that banks are completely jumping into this space. The smart banks are jumping into this space and saying, this is something that has the potential to disrupt us, to disintermediate us, to challenge our transaction banking revenues, to change our liquidity. We have got to get into this and keep control of this and be part of this new story.
Musheer, you want to step in?
Sorry. When we are looking at the future of money, right, as we've discussed quite a bit, I think this is a conversation that can go on for quite some time, but if we have to synthesize and think about the future of money with agentic, with CBDC, with traditional, and cash not going away, which now we have laws in certain countries which now have brought back the need for cash. And how are you envisaging the future of money with all of this coming together?
Yeah, I mean, we haven't really talked about cash. This is a super important thing which absolutely must not go away. Also from an inclusion point of view and from a resilience point of view. There are times when maybe the internet is down or when the electricity is down, and we've got to be able to continue to pay, especially in sort of crisis areas and in times of stress. You then don't also want to not be able to buy water or etc. So that is super important, and that is also interesting to see that some of these tokenized solutions have an offline variant, which is also much more resilient against network outages. So that's a super important topic. But you're asking more broadly about the future. Well, one thing we did in the book, after we've sort of had all the experts telling us what they think, and some of them disagreed, right? There's a chapter from the ECB about the digital euro. There's a chapter about Asia. There's a chapter about, and it's, we've covered all the geographies, all the use cases, all the regulatory sides, or security and identity. So we tried to cover all the dimensions. And the final chapter is a stab at what the future might look like. And since we don't have a crystal ball, and there probably isn't one outcome, there are probably going to be several things that are going to be happening and in parallel. What we did is a scenario analysis. We developed various scenarios and said it may go this way, it may go this way, it may go this way. And some people will not like some of them. I mean, there's one scenario which is a bit skeptical about CBDC, for example. Another one is more positive. And we've also attached some probabilities to each of the scenarios, which was quite speculative, of course, but this is just putting our judgments together to try and see what the future may look like. And since the book draws on people from all dimensions of the topic, there are academics, there are central bankers, there are commercial bankers, there are practitioners, service providers. So we've tried to look at it from all dimensions. That is sort of our summary of where the future may be. And I'm afraid you're going to have to buy the book to find out what these scenarios are.
Thank you so much, Michael. We are reaching the very end of this conversation, but there's so much to unpack, and we've only possibly scratched the surface on a lot of the movements on the future of money. And we'd love to offer everybody who's listening in to buy the book and to actually read on the take associated with the entire ecosystem, and not just with a certain side of the ecosystem, which is very bullish on the certain type of money. But what I really liked, and I wish I could have spent more time, was about how the future of money is not going to be based or biased by the technology alone, but is actually going to lead to certain use cases as well as certain institutions getting disrupted completely, and that the future is actually happening as we speak right now. And we're going to have systems which are going to scale, which are going to be worth billions and millions of dollars, yes, but also going to reach many excluded. So this has been an absolutely fascinating conversation for me. And thank you, Michael, for giving us your time and talking to us about your book and about everything that you do. And with that, any parting thoughts from both of you before I hand back to Musheer to close the podcast?
No, just thank you so much. And just a small important addition. It isn't my book. I am just one of the editors. My other co-editors, one is a central banker and the other is a professor. So we've also tried to reflect the multidimensionality from the editorship. And so I mustn't take all the credit. That's for sure.
Thanks for that. We will looking forward to your next book. Let's hope it will then. We'll have that on a different element and have you back. Once again, echoing Monica, it was fascinating conversation and learning so much. And I look forward to seeing you in person in the coming months. I hope you do come to Asia and like a Hong Kong, if not to India for GFF in September. Audience, thank you so much for joining us. And I hope this has been a good, insightful conversation looking at how money is being reprogrammed, if I can use that term. But it's also a start of that conversation. We are now reaching a point where you have multiple instruments that you can utilize, and this conversation is healthy, but we will probably reach a stage where everything is harmonious, ideally, of course. So stay tuned for more decoding of fintech, digital assets, and artificial intelligence concepts here on the FinStep Asia FinTech Decoded podcast. Follow us, click like, subscribe, and share with your fellow friends and enthusiasts. On that note, take care. Goodbye.
Bye. Thank you very much.